Every time you check your bank balance, review a credit card statement, or look at where your money has gone over the past month, you are looking at a detailed portrait of your life. Your financial records show where you shop, what you buy, where you travel, what causes you donate to, and what habits you maintain. A complete set of financial records is, as one Supreme Court justice described it, a virtual biography of a person's daily life. You probably assume that those records are private, that nobody can look at them without your permission, and that your bank cannot simply hand them over to a government agency that comes asking. You probably assume that if the government wants to see where you spend your money, it needs to follow some kind of legal process, get a warrant or a subpoena, and that you have the right to know about it and to object if the request is improper. But that assumption, which feels as natural and as fundamental as the right to privacy itself, did not become law until 1978. Before that year, your bank records were legally considered the property of your bank, not your property. The government could access them without your knowledge, without your consent, and without any requirement to tell you it had done so. And the Supreme Court of the United States had ruled, explicitly and unanimously, on the key point that you had no constitutional right to stop it. The story of how Americans lost a privacy right they assumed they had, and how Congress tried to give it back, begins not with a surveillance scandal or a political controversy, but with an illegal whiskey still in rural Georgia. For most of American history, the privacy of your financial affairs was protected not by law, but by the practical realities of how banking worked in a country where institutions were local and relationships were personal. Banks were community institutions chartered by states, operated by local businessmen, and dependent on the trust of customers who lived in the same towns and knew the same people. A bank president in a small town in the 1930s knew his depositors personally, attended the same church, sent his children to the same school, and understood that his reputation and his business depended on keeping his customers' financial affairs confidential. The relationship between banker and customer was built on discretion and mutual obligation, the same way the relationship between a doctor and a patient or a lawyer and a client was built on the understanding that certain information was shared in confidence and was not to be disclosed without consent. If a government agent walked into a small-town bank in the 1940s and asked to see a customer's account records, the banker would likely have asked questions, consulted an attorney, and quite possibly refused to cooperate without a court order. Not because any federal law required him to protect his customers' privacy, but because his personal reputation in the community and the trust of every other depositor in the bank depended on him being the kind of banker who did not hand over private financial information to anyone who walked through the door and asked for it. This informal protection worked reasonably well in an era when banking was personal, local, and relatively small in scale. A customer who felt his banker had breached his confidence could take his business across the street to the competing bank, and the resulting reputational damage would serve as a strong deterrent against future disclosures. But this system of protection depended entirely on the culture and character of individual bankers rather than on any legal framework that customers could enforce in court. There was no federal statute that declared your bank records private, no regulation that explicitly prohibited your bank from sharing your complete financial history with anyone who asked for it, whether a government agent, a private investigator, or a curious neighbor who happened to know someone at the bank. No legal principle established in any federal court gave you standing to object if your bank decided to cooperate with a request for your records, whether that request was backed by a warrant signed by a judge or simply by an informal phone call from a federal agent who thought your transaction patterns looked interesting. The privacy you enjoyed as a bank customer was a professional custom, not a legal right, and customs can disappear overnight when institutional priorities change or when the people in authority decide that the custom is inconvenient. The first major change came in 1970, when President Richard Nixon, who had not yet been caught surveilling his own political opponents, signed the Bank Secrecy Act into law. The timing would later seem ironic, as the president who was signing legislation to expand the government's ability to monitor citizens' financial activities would within a few years be exposed for conducting illegal surveillance of his own. But in 1970, the BSA was not a privacy controversy. It was a law enforcement initiative, and it passed with overwhelming bipartisan support. The BSA was not designed to protect financial privacy. It was designed to eliminate it, at least as it applied to the government's ability to track the financial activities of suspected criminals, tax evaders, and organized crime figures. Congress had held extensive hearings documenting cases in which lawbreakers had used the bank secrecy laws of foreign countries, particularly Switzerland, to hide money from American law enforcement and the Internal Revenue Service. The fear that the rise of international air travel and increasingly sophisticated financial networks were making it easier for Americans to move money offshore had created a political consensus that the federal government needed broad access to financial transaction data on a scale that had never existed before in American history. The Bank Secrecy Act required every bank in the United States to maintain detailed records of all financial transactions conducted by its customers and to retain those records for specified periods, creating a comprehensive archive of American financial activity that the government could access through legal process or, as would later become clear, through informal cooperation from banks that saw compliance as easier than resistance. It required banks to file currency transaction reports with the Treasury Department for any domestic transaction involving more than $10,000 in cash, creating a paper trail for large cash movements that law enforcement and intelligence agencies could follow. It required reporting of certain international currency transfers exceeding $5,000, addressing the fear that Americans were hiding money in foreign accounts to evade taxes. And it gave the Secretary of the Treasury broad authority to issue additional regulations specifying what records banks must keep, what transactions they must report, and how long they must retain the information. The law effectively transformed every bank in America from a private business that served its customers into a surveillance instrument of the federal government, required by law to monitor, record, and report its customers' financial activity to federal authorities on an ongoing and permanent basis. The customer who deposited $10,000 or more in cash was not committing a crime by making the deposit. The transaction was perfectly legal. But the bank was required by federal law to report it to the Treasury Department as if the mere fact of the transaction were suspicious and worthy of government attention. The law passed the House of Representatives by a vote of 302-0. The Senate passed it by voice vote. Nobody in either chamber voted against it. The speed and unanimity of its passage reflected a political environment in which the fight against organized crime, tax evasion, and financial fraud was considered so urgently important that the privacy implications of requiring banks to report on their own customers' activities barely registered as a political concern. The few voices that raised questions about the constitutional implications were overwhelmed by the bipartisan consensus that the benefits of financial transparency outweighed any costs to individual privacy. The privacy implications were enormous, however, and they became apparent almost immediately after the law took effect. The American Civil Liberties Union, the California Bankers Association, and individual bank customers who objected to having their transactions reported to the government challenged the Bank Secrecy Act in federal court, arguing that the record-keeping and reporting requirements constituted an unreasonable search of their financial activities in violation of the Fourth Amendment. The challengers contended that requiring banks to record and report every significant transaction was functionally equivalent to the government conducting a warrantless search of every customer's financial life. The case reached the Supreme Court in 1974 as California Bankers Association versus Schultz. The court upheld the Bank Secrecy Act in a 6-3 decision, ruling that the record-keeping and reporting requirements did not violate the Constitution. Justice William Rehnquist, writing for the majority, held that banks and their customers did not possess an unqualified right to conduct their affairs in secret, and that the government's interest in detecting and preventing financial crimes justified the reporting requirements the Act imposed. 3 justices dissented, and their dissenting opinions were prescient warnings about where the legal and technological trajectory was heading. Justice William Douglas, who had been the court's most vocal defender of individual privacy for over 3 decades, warned that the Bank Secrecy Act was creating a system of comprehensive financial surveillance that treated every American bank customer as a potential suspect, monitoring their transactions not because they had done anything wrong, but because their data might be useful to the government at some future date. Justice Thurgood Marshall argued that the Act's mandatory reporting requirements violated the Fourth Amendment by compelling banks to disclose private information without probable cause or individualized suspicion. William Brennan wrote separately to emphasize that the scope of the information being collected, records of virtually every significant financial transaction in the country, made the constitutional concerns far more serious than the majority had acknowledged. The majority disagreed with each of these objections, and the Bank Secrecy Act stood. But the dissenters' concerns would prove to be remarkably accurate predictions of the privacy conflicts that would follow. The California bankers' decision was significant but narrowly focused on the constitutionality of the Act's reporting requirements. The broader and more fundamental question, whether individual bank customers had a constitutional right to privacy in the records their banks maintained about them, was left for another day and another case. That day came 2 years later, and the answer the court gave would reshape the relationship between Americans, their banks, and their government for a generation. In 1976, the Supreme Court decided United States versus Miller, and the ruling would become one of the most consequential privacy decisions in the history of the American legal system. A decision whose implications would extend far beyond banking and far beyond the facts of the case itself. The case began in rural Georgia, where a man named Mitch Miller was being investigated by the Bureau of Alcohol, Tobacco, and Firearms and the United States Treasury Department on suspicion of operating an unregistered whiskey distillery. The charges were serious, and the federal agents building the case needed to trace Miller's financial activities to establish a pattern of income and expenditure that would support the allegations. Rather than approaching Miller directly, seeking a warrant from a judge based on probable cause, or using any of the traditional legal mechanisms that the Fourth Amendment was designed to require, the agents chose a simpler path. They presented grand jury subpoenas directly to the two banks where Miller held his accounts and asked the banks to hand over his records. The banks complied immediately, without hesitation, and without any sense that they were doing something unusual. They turned over copies of Miller's account statements, deposit slips, canceled checks, loan applications, financial statements, and detailed transaction records covering months of financial activity. The agents received a comprehensive and granular picture of Miller's financial life, a record of where his money came from and where it went, without Miller ever knowing that his records had been requested, accessed, copied, or reviewed. He learned about the government's access to his financial records only when the evidence obtained from those records was introduced against him at trial, by which point the question of whether the access was proper had already been rendered moot by the fact that the government already had the information. Miller's defense attorneys challenged the use of the bank records, arguing that they were his private papers, protected by the Fourth Amendment's guarantee against unreasonable searches and seizures. The Fourth Amendment had been interpreted for nearly 2 centuries as protecting citizens from government intrusion into their private affairs without proper legal process, typically a warrant issued by a judge based on a showing of probable cause. Miller's attorneys contended that a person who deposits money in a bank, writes checks to pay bills, and conducts ordinary financial transactions has a reasonable expectation that those records will remain private, and that the government cannot access them without following the same constitutional procedures required to search a person's home or seize their personal belongings. The argument felt intuitively right to most Americans who heard about the case. Your bank records are private. The government cannot just walk into your bank and read your account history, and you have a right to know if someone is looking at your financial life. These felt like truths so self-evident that they did not need to be argued, only stated. The Supreme Court was about to explain in devastating detail why every one of those assumptions was wrong. If you want more stories like this, subscribe. Now let me tell you what the Supreme Court decided and why it matters to every American with a bank account. Miller challenged the use of his bank records, arguing that they were his private papers, protected by the Fourth Amendment's guarantee against unreasonable searches and seizures. His attorneys contended that a person who deposits money in a bank and conducts financial transactions through that bank has a reasonable expectation that those records will remain private, and that the government cannot access them without following the same constitutional procedures it would need to search a person's home. The Supreme Court disagreed in a ruling that stunned civil liberties advocates and privacy scholars. The reasoning the court used to reach its decision created a legal doctrine that would define the limits of financial privacy in America for decades to come, and that would extend far beyond the facts of a bootlegger's case in Georgia. The court held that Miller had no Fourth Amendment interest in the records maintained by his bank. The checks, deposit slips, account statements, and transaction records were not Miller's private papers, the court ruled. They were the bank's business records, documents created and maintained by the bank in the ordinary course of its commercial operations. Miller had voluntarily conveyed his financial information to the bank when he opened his accounts, deposited money, wrote checks, and conducted transactions. By sharing that information with a third party, the bank, he had assumed the risk that the bank might reveal it to others, including the government. Having voluntarily exposed his financial information to bank employees, the court reasoned, Miller could not claim a reasonable expectation that the information would remain private. The principle the court articulated became known as the third-party doctrine, and its implications reached far beyond one man's bank records in Georgia. Under the third-party doctrine, any information you voluntarily share with a third party, any third party, loses its Fourth Amendment protection entirely. You have no reasonable expectation of privacy in information that you have already shared with someone else, because the act of sharing it means you have accepted the possibility that it might be disclosed further without your knowledge or consent. Applied to banking, the doctrine meant that every transaction you conducted through a financial institution was information you had voluntarily shared with your bank, and your bank could share it with the government without telling you, without asking you, and without giving you any opportunity to object. Every check you wrote, every deposit you made, every transfer you initiated, every loan you applied for was data that belonged to the bank, not to you, and the bank's decision to share that data with the government required no more legal process than a phone call from a federal agent. The Miller decision was announced on April 21, 1976, and its impact extended immediately beyond the financial sector. The third-party doctrine applied not just to banks but to any institution that maintained records about its customers in the ordinary course of business. Phone companies that kept records of the numbers their customers dialed, utility companies that recorded when customers used electricity and how much they consumed. Later, internet service providers, email platforms, and social media companies would all fall under the same principle. Any record you generated through your interaction with any business was the business's record, not yours, and the government could access it without a warrant, without probable cause, and without your knowledge. The reaction in Congress was swift and genuinely alarmed. Privacy advocates, civil liberties organizations, and members of both parties recognized that the Supreme Court had effectively eliminated constitutional protection for one of the most sensitive and revealing categories of personal information in modern life. Your home was protected by the Fourth Amendment. The diary in your bedside drawer was protected. The letters in your desk were protected. But the financial records that documented every dollar you earned, every purchase you made, every donation you gave, and every payment you received, records that revealed far more about your daily life, your associations, your beliefs, and your habits than the contents of any desk drawer, had no constitutional protection at all. The court had ruled that by using a bank you had waived your privacy in your own financial life. Congress moved to fill the gap that the Supreme Court had torn open. In 1978, as part of the Financial Institutions Regulatory and Interest Rate Control Act, Congress passed the Right to Financial Privacy Act. The RFPA was designed to accomplish through legislation what the Constitution, according to the Supreme Court, did not accomplish on its own: create a legal framework that gave Americans a meaningful right to privacy in their bank records, a right they could enforce in court and that the government would be required to respect. The RFPA established specific and detailed procedures that federal government agencies were required to follow before they could obtain a customer's financial records from a bank, credit union, credit card company, or any other financial institution covered by the Act. Under the law, the government could access financial records only through one of 5 carefully defined legal channels: a written authorization signed by the customer, an administrative subpoena or summons issued by a federal agency, a search warrant issued by a court, a judicial subpoena issued in connection with a pending legal proceeding, or a formal written request that met specific statutory requirements set out in the Act itself. Each of these channels required some form of legal process, documentation, and accountability, replacing the informal system under which a phone call from a federal agent had been sufficient to obtain any customer's records. The notification requirement was the heart of the law and its most significant departure from the pre-Miller status quo. Before the RFPA, customers had absolutely no way of knowing that the government was accessing their financial records. Their bank could hand over account statements, transaction histories, and loan applications to federal agents, and the customer would never learn about it unless the information was used against them in a legal proceeding, by which point it was far too late to object. The RFPA changed that by requiring, in most circumstances, that the customer receive advance written notice of the government's request, along with a clear statement of the customer's right to challenge the request in court. If the customer filed a challenge, the government had to demonstrate to a judge that it had a legitimate reason for accessing the records before the bank could be compelled to release them. The RFPA also gave customers the right to recover damages if their bank released their records in violation of the Act's requirements. Financial institutions that disclosed customer records without proper legal process could be liable for actual damages, court costs, and attorney's fees. This provision gave the law enforcement weight that a purely procedural requirement would have lacked, because it meant that banks had a financial incentive to comply with the Act's requirements rather than simply cooperating with every government request that came across their desks. The law represented a genuine and historically significant step forward in recognizing that Americans had a right to expect some degree of privacy in their financial affairs. But the RFPA was enacted with 20 separate exceptions to its protections, and those exceptions collectively carved out so many categories of permissible government access that the law's protective umbrella was considerably smaller than its language suggested. Law enforcement agencies investigating potential crimes could access records under expedited procedures that limited the customer's ability to challenge the request. The IRS had its own dedicated exceptions for tax investigations. Intelligence agencies had exceptions for national security. Financial regulatory agencies could access records during routine oversight without following the RFPA's notice requirements at all. And law enforcement could obtain emergency access without prior notice when delay might result in evidence being destroyed. The list of exceptions was so extensive that legal scholars argued the law was less a shield for consumers than a detailed instruction manual for government agencies, showing them exactly which procedural door to use to bypass the protections. Every exception was individually justified by a legitimate interest, but collectively they covered such a broad range of government activities that the situations in which the RFPA's full protections applied were narrower than the situations in which they did not. The USA Patriot Act, passed after September 11, 2001, expanded the government's ability to access financial records further, adding new exceptions and broadening the Bank Secrecy Act's reporting scope. The digital transformation of banking compounded the problem by creating unprecedented volumes of financial data that were easier to store, search, and access than anything that existed when the RFPA was written. The story of financial privacy in America is a story of a right that every American assumed they had until the highest court in the country explained in clear and unambiguous terms that they did not. The informal privacy that protected your financial records when banking was local, personal, and built on community trust was never replaced by a legal framework of equivalent strength or comprehensiveness. The Bank Secrecy Act of 1970 made your bank a reporting agent of the federal government. The Miller decision of 1976 made your bank records the bank's property rather than yours, stripping away even the theoretical possibility that the Constitution might protect them. And the Right to Financial Privacy Act, which was supposed to fix the problem Congress recognized the court had created, fixed it with a law that contained 20 exceptions, each one a door that the government could walk through without triggering the protections the law was designed to provide. Every notification you receive when the government requests your bank records, every procedure your bank follows before turning over your financial information to a federal agency, every right you have to challenge a government request in court before your records are released, traces back to a law that was passed in 1978 in response to a Supreme Court case about a bootlegger in rural Georgia. Before that law, the government could look at your complete financial history, every deposit, every withdrawal, every check, every transfer, without telling you it was doing so, without asking your permission, and without giving you any opportunity to say no. The wall between your financial life and the government's ability to examine it was not built by the Constitution. The Supreme Court made that clear in 1976. It was built by Congress 2 years later, and it was built with 20 doors.